right, welcome back to the deep dive. Diving into the world of retirement investing and specifically building a portfolio that doesn't just sit there, but cranks out some serious income.
Yeah.
And today we're talking about supercharging retirement, really juicing it up. We found this article that really piqued our interest. It's called Supercharge Your Retirement with Income Machines Paying Fat Dividends. And retirement planning, it's a puzzle, right? But we're here to put the pieces together.
Yeah, absolutely. And one of the first pieces we might want to kind of, re-examine is that classic 4% rule. That idea you can safely withdraw 4% of your portfolio every year in retirement.
Yeah.
It's been the standard for a long time. But it might not be ideal for everyone, especially if you're looking for a really consistent income without having to touch your principal.
Makes sense. So are we talking about living entirely off dividends? Is that even realistic?
It can be. It certainly can be with the right strategy. And the beauty of a dividend-focused approach is that you aim to preserve that capital, or keep that money working for you while you enjoy that steady income stream.
Right.
It's like, financially speaking, having your cake and eating it too.
I like that. Okay, so let's dive into the specific investments this article highlighted. The first one that really caught my eye was the Schwab U.S. Dividend Equity ETF, ticker symbol SCHD. Now, what's interesting here is that it doesn't seem to be about chasing the highest yield. It seems to be more about quality and consistency.
Absolutely. SCHD focuses on those companies with a proven track record, not just paying dividends, but growing them consistently.
Right.
In fact, they've got an impressive 13 years of consecutive dividend increases. And that consistent growth, it's reflected in their 10-year dividend, CAGR, 11.04%.
Whoa.
Meaning those dividends have been growing at an average rate over 11% per year for the past decade. It's a powerful indicator of that long-term performance potential. And, of course, let's not forget the incredibly low expense ratio, just 0.06%.
That's tiny.
Tiny, meaning more of your returns stay right there in your pocket.
I like it. So SCHD sounds like a solid foundation for a dividend portfolio, but wouldn't you also want some higher yield options to really boost that income stream?
You're absolutely right. And that's where our next fund comes in. The NEO's S&P 500 High Income ETF, ticker symbol SPYI. Now, this one aims for a 1% monthly distribution. That translates to roughly a 12% annual yield.
Okay, 12%, all right.
But how do they achieve that? Well, they use a covered call strategy.
Covered calls, yeah, that rings a bell. Can you break that down for me?
Of course. Imagine you own a stock and you believe it's going to stay within a certain price range. You can sell a call option to another investor. This gives them the right to buy your stock at a specific price within a set time frame. In return, you get a premium. And that's where that extra income comes from.
So you're essentially getting paid for the potential of someone else buying your shares.
Yeah.
But doesn't that limit your potential upside if the stock price just, skyrockets?
That's the trade-off with covered calls, right?
Right.
They can generate significant income, but they also cap your potential gains. So it's a strategy that prioritizes that income over the potential for, massive growth.
Right. Makes sense. SPYI also has another interesting feature, right? Something about the way its distributions are taxed.
Yes. About 60% of SPYI's distributions are taxed at the more favorable long-term capital gains rates rather than ordinary income rates. So this can be a really big advantage for investors who hold it in a taxable account.
Interesting. So we've got SCHD for quality, that consistent growth, and SPYI for high yield with some potential tax advantages. Are we sensing a theme here, building this kind of dividend ladder with different types of investments?
You're catching on. And to round out this part of our ladder, let's talk about a fund that focuses on an asset class that's known for its income potential preferred stocks. We're looking at the Virtus InfraCap U.S. Preferred Stock ETF, PFFA.
Okay, now preferred stocks, those are kind of a hybrid between stocks and bonds, right?
Right.
They pay a fixed dividends like a bond, but they also have that potential for price appreciation like a stock. Am I on the right track?
You got it. And PFFA focuses specifically on preferred stocks issued by real asset businesses, like those in the real estate and infrastructure sectors. They tend to be more stable, less volatile than other types of companies.
So it's like getting a piece of those more stable income-producing sectors, but with that added benefit of potential price appreciation. I like that. But I did notice that PFFA has a higher expense ratio compared to SCHD and SPYI, 2.52%. Is that something to be concerned about?
It's definitely worth considering, but it's important to understand that higher expense ratio is mainly due to the fund's use of leverage, which can amplify those returns. And despite those fees, PFFA boasts a pretty attractive 9.41% forward dividend yield, and it has a history of outperforming the broader preferred stock market.
So it seems like you're paying a bit more for the potential to earn a bit more. Interesting. Makes sense. Okay, so we've laid the foundation for our dividend ladder with those three funds, SCHD, SPYI, and PFFA. Each one offering a little bit of a different risk-reward profile and, add some diversification to our portfolio. Now, I'm curious to explore some individual stocks. This article highlighted a few that seem like they could really, juice up that dividend income. Where should we start?
Well, if we're talking about those reliable dividend payers, we can't overlook the real estate sector. And a company that immediately comes to mind is Realty Income, ticker symbol O. They're known as the monthly dividend company for a reason. They've been paying and increasing their dividends for over 25 years, making them a dividend aristocrat.
A dividend aristocrat. Okay, that's got to be a good sign, right? But what about the real estate market itself? We hear a lot about those rising interest rates these days, and I imagine that could impact REITs like Realty Income.
Yeah, it's true that rising interest rates can be a challenge for REITs. They often rely on borrowing to finance those property acquisitions, so higher interest rates can really increase their costs. However, Realty Income, they have a few things working in their favor. They have a very solid A credit rating, which gives them access to, those favorable lending terms. Plus, their portfolio of over 15,000 properties, it's incredibly diversified, with long-term triple net leases, which provide a really stable stream of income, even in those volatile markets.
So they've got a track record of dividend growth, diversified portfolio, and a solid credit rating. What kind of yield are we looking at here?
Right now, Realty Income is offering a yield of about 5.7%, and analysts are projecting a 4.2% dividend CAGR through 2029, which is pretty impressive considering that stability and track record they bring to the table.
I see what you mean. Okay, so Realty Income gives us that real estate exposure, which traditionally is considered a good hedge against inflation. Now, this article also mentioned an energy company, Enterprise Products Partners, ticker symbol EPD. I have to admit, I'm a little hesitant about energy stocks. The sector can be pretty volatile. What makes EPD stand out?
I understand the hesitation, but EPD, they're not your typical oil and gas exploration company. They're a midstream infrastructure company, meaning they focus on transporting and storing energy products regardless of those price fluctuations in the underlying commodities. They own a vast network of pipelines, terminals, and storage facilities, making them an essential part of that energy supply chain.
So they're more like the picks and shovels of the energy industry rather than the gold miners themselves, less exposed to those, wild price swings.
Exactly. And that stability, it's reflected in their impressive dividend history. They've been paying and increasing their distributions for over 20 years. And right now, they're offering a very enticing 6.5% yield.
Whoa, 6.5%. That's pretty hard to ignore. But this article did mention something about EPD issuing a K-1 form instead of a 1099. Now, I'm not a tax expert, but I know K-1s can be a bit more complicated to deal with, come tax time.
That's true. EPD is structured as a master limited partnership, an MLP, which means they issue those K-1 forms. K-1s report your share of the partnership's income, gains, losses, deductions, and credits. They can be a bit more complex to file than a standard 1099, so it's definitely something to keep in mind, especially if you're considering holding EPD in a retirement account.
Good point. So we've got Realty Income for that stable real estate income and EPD for high yield from the less volatile side of the energy sector. Now, this last stock pick, it's a little different, right? It's a business development company, a BDC called Main Street Capital, ticker symbol MAIN. I'm not too familiar with BDCs. What's the story there?
BDCs are essentially specialized lenders. They provide financing to those small and mid-sized businesses. They often invest in those private companies, which can offer higher returns but also come with higher risk.
So Main is giving us access to private market lending, potentially higher returns but also higher risk. What about their dividend track record?
Main is known for its generous dividends. They currently offer a yield of around 6.5%, including supplemental dividends.
Supplemental dividends. So they pay regular dividends and then they throw in some bonus dividends on top. That sounds pretty appealing, but are those dividends sustainable?
Well, they do have a solid investment-grade credit rating, and their management team is known for being very shareholder-friendly. However, it is worth noting that their dividend growth rate is a bit slower compared to the other options we've discussed, projected to be around 1.6% MAGR through 2027.
Right, so it seems like the trade-off here is a potentially higher yield now, but maybe a little less growth in the future. It's all about finding that balance that works for you.
Right.
It's really fascinating to see just how many different ways there are to generate income from your investments. We've covered a lot of ground today, from those dividend growth ETFs, REITs, and even private market lending through those BDCs. I feel like my head is spinning a little.
It's quite a landscape to take in, but that's why it's so important to approach this strategically, just like we've been talking about, with this dividend ladder concept.
Yeah.
You can start with that solid base like SCHD for that broad market exposure, consistent dividend growth. Then as you move up that ladder, you can add investments with higher yield potential like SPYI and its covered call strategy, or PFFA with that focus on preferred stocks. And then, of course, you can sprinkle in those individual stocks like Realty Income, EPD, and Maine to further, tailor the portfolio to your needs and risk tolerance, right?
So it's not just about chasing the highest yield, it's about building a well-rounded portfolio, balancing that risk and reward.
Exactly.
And of course, this is all just a starting point. We've only scratched the surface here. There's a whole world of dividend-paying investments out there.
Oh, yeah, absolutely. We always encourage listeners to do their own research, delve a little deeper into these ideas, consult with a financial advisor to really create a plan that aligns with, your own individual goals and circumstances. Remember, this isn't a one-size-fits-all approach. Your retirement income strategy should be as unique as you are.
And one that has become crystal clear throughout this whole deep dive is that you just don't have to settle for that traditional 4% rule. Building a portfolio that generates significant dividend income, it's a very real possibility.
Absolutely. And think about that peace of mind that comes with knowing your investments are working hard for you, generating that passive income stream to help you live the retirement lifestyle you've always dreamed of.
It's truly inspiring. We hope this deep dive has sparked some ideas, maybe given you a solid foundation to build on. Remember, the best time to start planning for your dream retirement is always now.
So, as you continue on your journey, we'll leave you with this thought. What combination of these income-generating powerhouses will you choose to supercharge your retirement portfolio?
Until next time, happy investing.